Hello everyone, welcome to JIB CIB Prep. In today's video, we will discuss unit number 8, Foreign Exchange Remittance Facility for Individuals. In this unit, we are going to learn about FEMA. What are the main features of FEMA? Why there was a need to change from FERA to FEMA? What are the important definitions? How can one bring and take out foreign exchange? What are inward remittances, outward remittances? And we will learn about Indo-Nepal remittance scheme. After that, we'll follow our course of practicing questions. First, we will take up Macmillan questions and then we'll take up some other questions. So let's begin our session. Uh, why there was a need for foreign exchange? So one of the main reasons the world has grown economically is because countries trade and persons travel with each other. When businesses and people from different countries deal with one another, they use different currencies. So there has to be a system to convert one currency into another currency. For example, if someone from India wants to buy goods from the US, they'll need to pay in dollars. And that's where foreign exchange comes in. It's a system that helps convert currencies, making global trade and travel possible. But here's one thing, not every country has the same amount of foreign exchange like US dollars or euros or Kuwaiti dinars. So each country has to manage its foreign exchange carefully. And in India, this job is done by the Reserve Bank of India. The RBI makes sure there's a proper system in place to handle the exchange of currencies and support both businesses and personal needs. Now let's move forward to evolution of FEMA. Now after independence, India didn't have much foreign exchange. So India didn't have much foreign currency. So it was considered precious and limited. So strict rules were made to control its use. And when we talk about the timeline, in 1939, during World War II, India started controlling foreign exchange under special defense rules. So there were special defense rules. And then in 1947, there was a law called FERA, Foreign Exchange Regulation Act. It was introduced to strictly monitor foreign currency uses. And again in 1973, so in 1939, we have special defense rules. In 1947, so FERA actually originated in 1947 with a base of 1939 rules. So in 1947, FERA came into force, and in 1973, a stricter version of FERA came into force. However, over time things changed. Indian economy started opening up and global trade increased. So a more flexible and business-friendly law was needed. That's why in the year 2000, FERA was replaced by FEMA, Foreign Exchange Management Act. And what was changed? So, under FERA, breaking foreign exchange rules was a criminal offense. It was a crime. But under FEMA, it is treated as a civil offense, like a rule is violated, but nobody has committed a crime. So, you will not put a person behind the bars, just like in a criminal offense. So, in FERA, it was a criminal offense, and in FEMA, it became a civil offense. FEMA made foreign currency dealing easier, especially for businesses doing international trade. Why managing foreign exchange is important? What is the need for this management? So, the foreign exchange market. So, what's the need? So, the foreign exchange market is the largest and fastest moving market in the world. It is activated 24 into 7 and it's very competitive. While this brings opportunity, it also brings risk. For example, if the value of rupee falls suddenly, it could increase the cost of imports, right? So India needed to keep enough foreign currency reserves to avoid problems during emergencies and focus on exporting more goods to earn foreign currency. This is a shift from the old strategy of avoiding imports to promoting exports. Now let's understand key features of FEMA. So FEMA was designed to support easier foreign trade and payments, and it is designed to support a smooth and well managed foreign exchange market. So what are the main features? Number one, the central government can make rules. The central government can make rules to control foreign exchange activities if needed. Only those approved by the RBI, known as authorized persons like banks, licensed dealers, they can carry out foreign exchange transactions. And sending and receiving money to or from someone outside India is restricted, and rules must be followed. Uh, People living in India cannot just go and buy property abroad freely. So it is controlled. If someone wants to receive money from outside or invest in foreign securities, they usually need RBI's permission. So RBI's permission is required. And with respect to current account controls, the central government can restrict spending in foreign currency under the current account. For example, for education, medical treatment, travel, if it is in public interest. RBI can place restrictions on capital account for investment loans to ensure economic stability. And if someone had foreign currency shares or property when they lived abroad or inherited them from someone who lived abroad, they can keep it even after returning to India. So these are some of the key features. Before moving forward to the definitions, let's take some examples to familiarize ourselves with this Foreign Exchange Management Act. Let's say Mr. R. Mr. R lived in US and he bought a house there. Later, he returned to India from US to India. Now, keep that in mind. He already has a house in US. And according to FEMA, Ramesh can still keep that house because he bought it while he was abroad. And now there's a person called P. Now, P wants to send money to his brother in UK to invest in foreign shares. Now he will have to follow foreign exchange management rules and he may require permission from the RBI. Now let's move on to some important definitions. Authorized dealers. So an authorized dealer is a person or company, usually bank, that is officially allowed by RBI to deal in foreign exchange. For example, HDFC Bank, SBI, they can be authorized dealers. And in authorized dealers, we have three categories, category 1, 2, and 3. Now, category 1, these are the dealers, banks, or institutions that RBI allowed to do all type of foreign exchange transaction, both current and capital. So, SBI doing remittances and NRI account operations. So, SBI is AD category 1. AD category 2, these are institutions that are allowed to do non-trade related transactions like private remittances or travel related exchanges, and it includes upgraded money changers, some RRBs, some UCBs, urban cooperative banks. So they are included in AD2 category. AD3, these are businesses allowed by RBI to do specific foreign exchange transactions connected to their business. So a travel company allowed to accept forex for booking tickets is AD category 3. So I hope authorized dealer is clear to you. Authorized person, so this is a broad term and it includes authorized dealers, money changers, offshore banking units, anyone else allowed by RBI to handle foreign exchange. Capital account transaction, so any transaction that changes ownership or asset or liability across countries is a capital account transaction. For example, an Indian buys property in US or an NRI invests in shares in India. So these are capital account transactions. Current account transaction, these are regular transactions like payment for business and trade, interest on loan or investment income, family maintenance. which is sent abroad, foreign travel, education, medical expenses. So these all are current account transactions or transaction which does not alter asset or liabilities of a person is a current account transaction. So sending money to a child who's studying in US. So in which category will you categorize this transaction? It will come under the current account transaction. Foreign exchange, it includes foreign currency, deposits and credits in foreign currency, checks or letter of credits drawn abroad but payable in India, and checks drawn in India but payable in foreign currency. Foreign portfolio investments. So investment made by a person outside India in Indian shares or securities, which is less than 10%. So we'll categorize it as foreign portfolio investment. Not permanently resident. Someone staying in India for a specific job or time, which should not be more than 3 years. So they are not considered a permanent resident and they are known as not permanently resident. NRI, an Indian citizen who is living outside India. So a person is living outside India, but he is a citizen of India. He is known as non-resident Indian. Overseas citizen of India cardholder. So a foreign citizen who earlier was Indian or has Indian ancestry, say his parents were Indian or grandparents were Indian, or he or she is married to an Indian, is an overseas citizen of India. Please note, citizen of Pakistan and Bangladesh, they are not eligible for overseas citizen of India cardholder. PIO, person of Indian origin. So he is a person who is a resident of foreign country, who is a citizen of foreign country. Again, excluding the citizens of Pakistan and Bangladesh, and who was an Indian citizen earlier or has Indian heritage. So his parents, grandparents, great grandparents were Indian citizens. So this person is automatically a person of Indian origin, or he or she is married to an Indian. So we'll call them as person of Indian origin. So what's the difference between an NRI and PIO? So NRI is a citizen of India. PIO is a citizen of foreign country, not India. He resides in a foreign country. He's a citizen of foreign country, but again he has Indian heritage. Person resident in India. So a person who stays in India for more than 182 days in the previous year is known as person resident in India, but it excludes those persons who have gone abroad for a job, business, or a stay which is indefinite period of time. It is not certain when they will return to India, and the person who have come to India for a temporary basis. So they are not person resident in India. But person resident in India also includes a company which is registered in India, an Indian office of foreign firms, or foreign offices of Indian firms. They are included in the definition of persons resident in India. Remittance of assets. So sending money outside India from bank deposits, sale of property, PF or superannuation, insurance maturity, shares or other assets. If it is done legally under FEMA rules, so it is remittance of assets. Remittance is sending money from one place to another place. So when you send money outside India from your bank deposit, sale of property, PF, superannuation, insurance maturity or shares, it falls under the ambit of remittance of assets. Bringing foreign exchange to India. So any person, whether a resident or a non-resident, can bring foreign exchange into India without any limit. But there are certain rules attached to it. So a person has to declare his or her foreign exchange to customs by filling a currency declaration form. If he or she is carrying more than 10,000 US dollars in cash plus traveler's check, or he or she is carrying more than 5,000 US dollar in foreign currency notes. Otherwise, currency declaration form is not required. For example, if a person comes from US and he brings $15,000, So here, this person should declare this currency by filling out currency declaration form. Purchase of foreign currency from publics, bank and their agents, authorized persons mainly, so they can freely buy foreign currency from residents or non-residents. But there are important rules. If someone declare foreign currency at arrival, the bank must ask from that form, like currency declaration form, while buying it. And banks can give cash in INR for small transactions. Who can sell? So resident Indian can sell up to USD 1000 and non-resident or foreign visitors up to USD 3000. For example, if a US tourist gives the bank USD 2000, the bank can give them equivalent Indian rupees in cash if it's within the limit. Foreigners can also buy Indian rupees using their international credit or debit cards. And if the transaction is large, the Indian rupees will be given via check, draft, bank transfer, or debit card. Uh, there are encashment certificates. It is given when foreign currency is converted to INR, and it is required if a foreigner wants to reconvert unspent Indian money back into foreign currency. For example, a person came to India with, say, 5,000 US dollars. Now, he converted 2,000 or 3,000 US dollars into INR, but he only spent 1,500 INR, $1,500 worth INR, and 1,500 dollars worth INR is still left with him, and he is going back to US. Now, what will he do with this INR? So he wants to reconvert this unspent Indian money into dollars. At that point of time, he needs to give that encashment certificate, which was earlier given to this foreign tourist. Taking foreign exchange out of India. So foreign exchange cannot be taken out of India unless it was obtained legally from an authorized dealer, or it is allowed by journal or special permission from RBI. A tourist who bought USD 5,000 can take back only that much if it was declared on arrival and converted with an encashment certificate. Reconversion of Indian currency into foreign currency. A foreign visitor leaving India can reconvert unspent Indian currency into foreign currency if they show a valid encashment certificate. But what if they misplace their encashment certificate? So reconversion is allowed without encashment certificate in two cases. Number one, where the INR is up to rupees 10,000, and if the authorized person is satisfied with the reason for not having the encashment certificate and the departure is within 7 days. So this is case one. And case two, a foreign tourist can reconvert up to 50,000 withdrawn from ATM if they show valid passport and visa. Number one, confirmed air tickets and departure is within 7 days, and the ATM withdrawal slip, the original ATM withdrawal slip. In that case, they can convert INR, they can reconvert actually Indian currency to foreign currency without encashment certificate. Inward remittances. Inward remittance means money sent into India. The money is coming to India from a foreign country. An NRI working in Dubai sends money to his parents, say in dirham. So in Dubai, dirham is used. So he sends in dirham, converted into INR, received by parents. So this is an inward remittance. So the purpose is to support the family, support the business, or for investment. There are some general rules for inward remittances. So there is no restriction on how much money a resident can receive from abroad. Authorized dealers can buy draft, bill, other payment instruments in foreign currency from the public, and foreign exchange received must be sold to an authorized dealer within 180 days. And what happens if it is not surrendered within 180 days? It can be surrendered afterwards. But as a general rule, foreign exchange received must be surrendered within 180 days of its receipt. Now let's talk about some common methods of receiving money in India. So number one, there is bank transfer, bank wire transfer, in which there is a direct bank to bank transfer. It is most secure, most common. Bank money order, it works like a postal money order, but it is issued by banks. Uh, Postal money order uses postal services. Here it uses. So bank money order, it works like a postal money order issued by banks, and it generally takes more time. Foreign currency checks. So it is a check sent by post and deposited in the Indian bank account. It usually takes 20 to 25 days, but courier services can speed up this time. So it reduces the time. Foreign currency draft. Bank draft in foreign currency, it uses for businesses or payments to unknown person, and it usually take 21 days. Remittance cards. So they are reloadable prepaid cards in the name of the receiver. NRI loads money, receiver can withdraw from ATM in India. It is easy and cost effective. ACH transfer or direct deposit. So NRI authorizes their Indian banks to pull money from their foreign banks regularly. And it is good for regular family expenses. So is there any limit on inward remittance? What do you think? Will there be any limit? So no, there is no limit under FEMA. Anyone can send any amount to India, either to their own account or their relatives. Uh, FIRC is a foreign inward remittance certificate. It is not required when NRI send money to relatives, but it is required if money is received for business purposes, mainly to claim tax benefits. Outward remittance. So money is going out from India. So when someone living in India wants to send money abroad for travel, studies, gift, or other reasons, it is called an outward remittance. Now, the rules for sending such money are guided by Foreign Exchange Management Act, especially the current account transaction rules 2000. So, who can release foreign exchange for the now? Who can release foreign currency? So, only authorized dealers, mostly banks or approved by RBI. They can release foreign exchange for such purposes, but the government has created three categories of current account transactions to control how much money can go out and for what purpose. So there is no limit for inwards, but again there is limit for outwards. Number one, schedule one transactions. So these are prohibited transactions. These are the transactions for which you cannot send money abroad under any circumstances. What falls under schedule 1 transaction? So sending money abroad for lottery winnings, for horse racing, gambling, for buying banned magazines, or to participate in lottery schemes, for paying commissions for export if it relates to setting up your own company abroad like a joint venture, if sending commissions under certain government sponsored export scheme, except small amounts like 10% commission for tea and tobacco exports. If a person wants to pay for callback telephone services or sending interest earned from certain special NRI accounts, so it is prohibited. So in short, if it's lottery gambling suspicious scheme, it is prohibited under Schedule 1. Schedule 2 transactions, these are allowed but only after you get permission from the right ministry or department of the government of India. For example, if the purpose is culture tours abroad, Ministry of Culture's approval is required for ad in foreign newspapers costing over $10,000. So Ministry of Finance, sending freight charges for chartering a ship by PSUs. So Ministry of Surface and Transport for sending money to become a member of some club for no, for shipping insurance. So again, Ministry of Finance approval is required. So two transactions require prior approval of government. Then there are schedule 3 transactions, transactions which are allowed by authorized dealers. So these are the most common transactions that banks can allow directly without any special government permission. as long as they are within a limit. What is the limit? So USD 2,50,000 per person per financial year under LRS, it is the limit. For example, going on vacation abroad, sending gift or donation, going abroad for a job, shifting permanently abroad, sending money to close relatives, business travel, medical treatment, studying abroad. So these are scheduled here transactions. And what are the exemptions? So where can you exceed that 250,000 limit? So you can go beyond that 250 only in three specific cases: immigration, medical treatment, and education. So keep that in mind. And what are the exemptions from approval? So if someone has a resident foreign currency account or exchange earnest foreign currency account in India, they can use that money for permitted transaction, even those under Schedule 2 or 3, without needing government or RBI approval. And there's one also a special case which is worthy to discuss. So the people who are resident but not permanent resident. So these people live in India for work temporarily, like a foreign citizen working here or an Indian working for a foreign company's Indian branch for a short time, which is less than 3 years. Now they are allowed to send abroad their entire net salary after tax and deduction without any ceiling, because they are not permanently settled in India. Schedule 1 transactions 2, 3, we have already discussed these transactions. Also, one thing which needs to be discussed is if you are traveling abroad and you are using an international credit card, which is issued by a reputed bank, so you don't need RBI's approval for your expenses, even if they cross 2,50,000 mark. So this applies only if the card was issued by an overseas bank or an international agency. Keep that in mind. Fraudulent offers. So some fraudsters cheat innocent people by asking them to pay money like processing fees, conversion charges, tax clearance fees, by saying they will receive large funds later. And victims are tricked into depositing money in bank accounts in India, and that money is quickly withdrawn. So to manage this, banks must be very careful when opening accounts or allowing such transactions, especially when multiple accounts are opened in the name of different people or small firms for collecting these so-called charges, right? So for example, if someone tells you you have won a lottery abroad, but you must pay 50,000 for processing and ask you to deposit it in Indian bank account. So this is a fraud. All right. So be careful. Release of foreign exchange by authorized dealer category 2. So RBI has allowed some entities. So what are these entities? So travel agents, foreign forex service providers, basically authorized dealer category 2, to help people with foreign exchange for non-trade purposes. What are non-trade purposes? Going abroad for vacation, business travel, medical treatment. If a person wants to study overseas, for paying fees for global events, competitions, paying for exams like GRE, TOEFL, film shooting abroad, visa and immigration related services, or paying international membership fees. So these are non-trade related transactions, and here edit category 2 deals in this transactions. Medical expenses. So if a person living in India want to pay medical bills for their close NRA relative, now they can pay in Indian rupees. This is treated as a resident to resident transaction, and it is allowed. It includes payment for stay, payment for food, for travel inside India. So if your NRI brother visits India and needs hospitalization, you can pay for his hospital bills. Uh, Withdrawal of foreign exchange. So it is prohibited for. So Schedule 1 transaction. So you cannot take foreign exchange from India for anything which is listed in Schedule 1 to travel to Nepal or Bhutan, or dealing with people living in Nepal or Bhutan, unless RBI gives special permission. International credit cards. So you can use your ICC outside India, ICC's international credit card outside India or online for legal purposes, but it cannot be used for banned items like for lottery tickets, banned magazines, callback services, and there's no RBI limit on how much you can spend, but the card issuer again may set a limit. And people with foreign currency accounts in India or abroad, they can use ICCs freely, but this international credit card cannot be used in Nepal or Bhutan. And NRIs, PIOs can also get international credit card, but they must pay their card bills only through inward remittance or by their NRE or FCNR account. For example, a resident with a US dollar account can use ICC to book a hotel in Europe and pay from that account. So it is permitted. International debit cards. So these cards can be used only when traveling abroad. Payment and cash withdrawal allowed only for permitted current account expenses. And again, they can also not be used for buying any prohibited items, which we discussed earlier. Card payment for airline tickets. Some foreign airlines let you pay in INR, but processes the payment through a bank outside India. So this is not allowed under FEMA rules. And banks in India should inform airlines not to use overseas bank for INR payments. This has to be remembered. Store value charge or smart card. So bank can issue these cards to people going abroad for personal business trips, and they can be used for buying things for from shops overseas or for withdrawing money from ATMs abroad. But the usage is limited to legal and permitted current account purposes. Refund of unused foreign exchange and travel cards. So if a person has money left in his prepaid travel card, he can get it back, but after a cooling off period, which is 10 days from the last transaction. And the bank can deduct any unsettled authorized amount. A small balance can be kept, say up to USD $100 for pending transactions, and bank can deduct transaction fees. So if you return from a US trip and have say $300 left in your forex travel card, the bank will return your money, but after 10 days and after deducting if any payment charges and keeping a small buffer account. Liberalized remittance scheme, short for LRS. So the liberalized remittance scheme or LRS, it was introduced by RBI in India in 2004. Its current limit is 2,50,000, but earlier, initially the limit was 25,000 dollars only. So it allows resident individuals in India to send money abroad freely for certain purposes and without needing RBI approval. So who can use this? So LRS is available only to resident Indians, and it cannot be used by corporates, like companies, partnership firms, HUF trust. So they cannot use liberalized remittance scheme. It can only be used by resident individuals. Family members can combine their limit, but only if each of them meets LRS rules. For capital transactions like buying properties or share abroad, clubbing of limit is allowed only if family members are joint owners or they are co-investors. For example, if a father and son wants to buy property abroad jointly, they can combine their LRS limit. And what are the permissible amounts? Meaning to say how much can be remitted. As discussed, the maximum limit is USD 2,50,000 or 250,000 per person per financial year. So you can make any number of transactions as long as you don't cross this total limit. And if you want to send more than this limit, more than 2,50,000, RBI's prior permission it is required. And what are the permitted uses? What are the permitted purposes? Meaning to say, what can the money be used for? So LRS can be used for current account and capital account transactions. For current account transactions like travel abroad, gift and donations, we want to study abroad, medical treatments, immigration, maintenance of close relatives who are living abroad, or for business trips. And for capital account transactions, opening a foreign bank account, buying property abroad, investing in shares, mutual funds, starting a business, or giving loans to NRA relatives. Uh, and what are the restrictions? So you cannot send money for margin payments or speculations, or you cannot give money to another Indian who has foreign account, or say any transaction which is banned under FEMA. It is also not allowed. And so uh, you cannot send money to the countries which are blacklisted by FATF, or entities or people which are linked to terrorism as per RBI. So we have to keep this in mind. Of what are the conditions for specific purposes? So say private visits for tourism, USD 2,50,000 per financial year is permitted. It covers all travel costs like hotel transportations, and no forex is allowed for Nepal or Bhutan. For most countries, the cash limit is USD 3,000. For Iraq and Libya, it is 5,000 USD, and full amount in cash for Iran, Russia, or CIS countries. And for Hajj or Umrah, full cash as per Hajj committee rules. For gifts and donations, maximum you can gift is USD 2,50,000 a year. You can give to people abroad or donate to foreign organizations. For immigration, up to 2,50,000 or as required by the destination company. Extra funds are allowed only for settling in cost and not for getting immigration points. For maintenance of close relatives, up to again 2,50,000 annually. Close relatives which are defined under Companies Act. The limit is same for business trips up to 2,50,000. It includes training, conferences, apprenticeship, and if employer pays, so this is outside LRS. Medical treatment, again 2,50,000 without estimate. More is allowed if the estimate is shown. So this limit can be crossed, and an attendant can also take up to 2,50,000. If studying abroad, up to 2,50,000 without an estimate, and more is allowed if you show university fees detail. So if it is required, more money can be remitted. What are the remittance modes? How can you send the money? So you can open and maintain a foreign currency bank account, or remittance can be done through demand draft, bank transfer, or other standard banking channels. And again, a self declaration by the remitter is needed for remittance. Prohibited transaction, we have discussed it a while ago. So banks cannot give loans to help people to send money abroad. So no bank can credit to fund capital remittances. Remittance listed under Schedule 1 or 2 of FEMA, they are not allowed. You cannot send money to FATF blacklisted companies, or to group or peoples which are linked to terror activities as pointed out by RBI. And what documents do you need? So a person need to choose one branch of an authorized dealer, and that authorized dealer bank handles the LRS transaction. Form A2 needs to be submitted to buy foreign currency, and PAN number is provided for verification. Period of surrender of foreign exchange. So foreign exchange bought for a specific purpose can be used for any other permitted purpose later if not used for the original purpose. And if a resident individual receives or has unused foreign currency, they can surrender within 180 days. For example, if someone has bought USD 5,000 for studying in UK but didn't go, they can use that money for medical treatment abroad. Um, and so what happens if that 180 days are crossed? So even after 180 days, if the person comes to surrender the currency, the bank should not refuse just because the time is over. So if someone returns from the US and after 200 days they want to deposit their leftover dollars, the bank must accept it. A returning traveler is allowed to keep up to $2,000 in the form of foreign currency or traveler's check for future use. Keep this limit in mind. Uh, this might be asked in your examination. Operational guidelines for authorized dealers, authorized persons. So what are the responsibilities of authorized persons? The bank must take declaration from the customer that the transaction is not illegal or violating any FEMA rules. Bank must collect proof or documents from the customer to be reasonably sure that no rule is being broken. Bank must keep all records, copies of all documents related to the transaction. If the bank suspects any violation or misuse, so they must refuse the transaction in writing and report to RBI. Bank must follow all income tax laws while allowing any foreign exchange transaction. Banks must strictly follow KYC and AML guidelines, and for capital account transactions like buying property abroad, the applicant should have had a bank account with the same bank for at least 1 year. And if the customer is new to the bank, the banks must do extra checks like asking for bank statement from another bank or income tax return to verify the source of funds. Payment for foreign exchange must come from the customer's own funds, either by check, account debit, demand draft, debit or credit card, or prepaid card. And bank must certify that remittances are not being made to or received from banned people or organizations. Again, no loans or credit cards should be given to customers for making capital account remittances. All remittances made under LRS, they should be reported to FETRS. So what is FETRS? Foreign Exchange Transaction Electronic Reporting System. And for remittances below 25,000 US dollar, banks can keep a dummy form A2, a basic record of forex transactions. Uh, TDS on remittance to non-residents. So when sending money to someone outside India, banks must follow income tax rules and ensure that uh, TDS, tax deducted at source, is applied if required based on the latest Central Board of Direct Taxes instructions. Last topic of the day, Indo-Nepal remittance scheme. It was started by RBI in May 2008 along with Nepal Rashtra Bank. So it was designed to help Nepali migrant workers in India to send money easily and safely to their families in Nepal, and it uses NEFT system. So now National Electronic Fund Transfer is used in this remittance scheme. What are the key features? Um, the target group is Nepali workers in India sending money home, and it is only one-way remittance. So money goes from India to Nepal, not the other way around. Maximum limit per remittance is 2 lakh rupees. For non-customers or walk-in customers, the cash limit is 50,000 per remittance, and maximum 12 remittances per year are allowed. Money is sent in Indian rupees from India and given in Nepalese rupee in Nepal. It is available to both account holders and non-account holders. So how does it works? Remittances are processed through NEFT batches in Mumbai and they are routed through SBI's payment gateway made specially for Nepal. Money is received by the beneficiary through Nepal state bank branches or their approved agents. Banks must comply KYC and email checks on the person sending the money. For cash transactions for non-customers, the sender must give valid ID proof and this information must be recorded. Addresses and mobile number of both sender and receiver must be recorded before the money is sent. Now let's check your progress. Okay, one, as per FEMA, the basic criteria for a person to be considered as resident in India is the stay in India during the preceding financial year, which must be minimum of 90 days. No, 182 days. Yes, 180 no, 91 no. So the correct answer is B. Withdrawal of foreign exchange by resident is not permitted to visit. It is not permitted to visit Bhutan. So A is the correct answer for this question. The ceiling on the amount permitted to be remitted under LRS initially was it was initially 25,000 and currently it is 2,50,000. Remittances under Indo-Nepal remittance scheme are made under dash system and it is made under NEFT system, right? So let's move on to more practice questions now. Consider the following statement regarding Foreign Exchange Management Act 1999. FEMA replaced Foreign Exchange Regulation Act FERA 1947. So it actually replaced FERA 1973, not FERA 1947, making this statement incorrect. So it is FERA 1973 and not 1947. Hence, not correct. FEMA came into effect on June 1st, 2000. Yes, this is correct. Under FEMA, foreign exchange offences are treated criminal offence. No, it was treated as criminal under FERA. In FEMA, it is civil offences. So this statement is not correct. FEMA is not applicable to gift city. So this is correct. FEMA does not extend to Gujarat International Finance Tech City, gift city. So this statement is actually correct. FEMA permits individuals residing in India to hold foreign property acquired while they were non-residents or inherited from non-residents. So this statement is also correct. So 2, 4 and 5 is correct. So option B is the correct answer for this question. Consider the following statement related to FEMA definitions. Identify which of them are correct. A full-fledged money changer is authorized to sell foreign exchange for both private and business travel purposes. This statement is actually correct. Currency notes include only banknotes. No, currency note include banknotes and coins. So this statement is not correct. A foreign currency account is an account maintained in Indian rupee outside India. So foreign currency account is maintained in currency other than Indian rupees and not in INR. That's why it is known as foreign currency account, making this statement incorrect. So 2 is not correct, 3 is not correct. Foreign security includes shares and bonds denominations in foreign currency even if the return is payable in Indian currency. So this statement is actually correct. Capital account transaction involves changes in asset or liability of a person resident in India or outside India. This statement is also correct. So 1, 4 and 5, option A is the correct answer for this question. Mr. Ramesh, an Indian citizen, stayed in India for 190 days during the financial year 2023-2024. On April 10, 2024, he moved to Canada to join a full-time job in a multinational company. He has signed a 5-year employment contract and has shifted his family with him. He also rented out his house in India and has no plan to return in the near future. Meanwhile, his friend Mr. Ahmed, a Canadian national, came to India on February 1st, 2025 to start a new business venture. He intends to stay in India long term and has applied for business visa extension. Based on the above facts and as per the definition of a person resident in India, which of the following statement is correct? So Mr. Ramesh is a person resident in India because he stayed for more than 182 days in the previous year. But again, here Mr. Ramesh has no intention to return to India and he has moved to Canada for indefinite period of time. That is why this statement is not correct. Mr. Ahmed is not a person resident in India because he is a foreign national. Mr. Ahmed, though a foreign national, has come to India for business and intends to stay for an uncertain period, and that's why he is a person resident in India. So this statement is not correct. Mr. Ramesh is not a person resident in India because he left India for employment abroad with the intention to stay indefinitely. Yes, this statement is correct. both Mr. Ramesh and Mr. Ahmed are person resident in India. This statement is not correct. So option C is the correct answer for this question. Consider the following statements regarding foreign exchange bought into India and its encashment. CDF currency declaration form must be submitted if foreign currency note exceed 10,000. So CDF must be submitted foreign currency note exceeds 5,000 and not 10,000. So that's why this statement is not correct. No CDF is required if the total of foreign currency notes and traveler checks does not exceed USD 10,000. This statement is correct. So no CDF is needed if total currency plus traveler checks are less than or equals to 10,000 USD and currency notes are less than or equals to 5,000. Authorized persons can purchase foreign currency from both resident and non-resident. This statement is correct. Encashment certificate is mandatory for non-resident to reconvert Indian rupee into foreign currency. Also correct. Sale of Indian rupee against Indian credit cards to foreign tourists is not permitted. Sale of INR to foreign tourists is permitted against ICC. So this statement is not correct. So 2, 3 and 4 C. Option C is the correct answer for this question. Consider the following statements regarding reconversion of Indian currency by non-resident at the time of departure from India. Authorized person can reconvert unspent Indian currency into foreign currency only if a valid encashment certificate is produced. So this statement is correct. Reconversion up to 10,000 is permitted without encashment certificate provided the traveler is departing within 7 days and AP is satisfied. So this statement is also correct. Foreign tourists can reconvert 50,000 withdrawn from ATM without any documentation. So ATMs, if it is withdrawn from ATMs, but documents like passport, visa, air ticket, ATM slip, so these are required, making this statement incorrect. So 1 and 2 are correct. Here option A is the correct answer. Consider the following statement regarding remittance methods to India. Bank wire transfer typically take about 2 working days to complete. This statement is correct. Bank money order are faster than bank wire transfer? No. Uh, they are much slower and time consuming. So this statement is not correct. This is correct. This is not correct. Foreign currency checks can take up to 25 days unless expedited by courier service or service like cash later plus. So this statement is correct. So they can take anywhere between 20 to 25 days. So they usually take 20 up to 25 days. So this statement is correct. Foreign currency draft are ideal for sending money to well-known family members. Actually, foreign currency drafts are advisable when you are sending money to someone you don't know, to an unknown person. So this statement is not correct. Remittance card are reloadable debit cards that can be used at ATMs and stores in India. This statement is correct. So 1, 3 and 5 are correct. Option C is the correct answer for this question. Consider the following statements regarding the release of foreign exchange under FEMA Rules 2000. Remittances under Schedule 2 require prior approval from RBI regardless of source. So Schedule 2 transactions require prior approval, but they require prior approval of government ministries and not RBI. So this statement is not correct. Remittances made from EEFC account for Schedule 3 transactions are subject to threshold ceilings and require prior RBI approval if exceeded. So this statement is correct. Payments made through ICCs issued by Indian banks while abroad required prior approval of RBI if they cross the prescribed limit. So the statement is not correct. Remittance for the purchase of bank banned magazines and sweepstakes is expressly prohibited. Yes, it is mentioned under Schedule 1. So this statement is correct. They are expressly prohibited. Dividend remittance by companies to which dividend balancing applies is a permitted current account transaction under Schedule 2. So this is not correct. Remittance of dividend where dividend balancing is applicable, it is prohibited. Hence, they are not permitted. So this statement is not correct. Remittance for callback services of telephone are restricted and can be permitted by authorized dealers. So no, they are not restricted, they are prohibited. There is a difference. remittance of commission on exports under rupee state credit route is fully prohibited. No. So up to 10% of invoice value is permitted. Hence, they are not fully prohibited for all products because it is allowed for tea and tobacco. Though it is allowed only for tea and tobacco, this makes this statement incorrect because it said it is prohibited for all products. Hence, this statement is not correct. Which of the following statements are correct? So, statement 2 is correct, statement 4 is correct, and remaining statements are not correct. So, B is the correct answer for this question. Consider the following statements regarding the redemption of unutilized balance on prepaid cards by resident Indians. Refund of the unutilized foreign exchange balance can be requested only after 10 days from the date of last transaction. This is correct. There is a 10 days cooling off period. Authorized person are allowed to retain maximum of 500 USD. No, it is actually 100 USD, not 500 USD. Transaction fees and service tax, if applicable, are payable in Indian rupees. So this is correct. So statement 1 and 3 are correct for this question, making option B as the correct answer. Evaluate the following statements regarding the liberalized remittance scheme. So the LRS was introduced in 2004 and to simplify individuals' remittance and subsume certain current account transaction provisions. So this statement is actually correct. So LRS was launched in 2004 and it replaced specific provisions for current account transactions. Remittances under LRS can be consolidated across family members even for capital account transactions irrespective of ownership. So no, if there is a clubbing for capital account transaction, then family members are needs to be co-owner or co-investors, right? So this irrespective of ownership makes this statement incorrect. The scheme permits resident individuals to invest in unrated debt securities and promissory notes issued by foreign entities. So, investment in these unrated debt securities and notes are permitted under capital account transactions in LRS. So, this statement is correct. Resident individuals can retain, invest, and repatriate the income earned on overseas investment acquired through LRS without RBI approval. So, individuals are allowed to retain and reinvest income which they earned abroad without prior RBI approval. So, this statement is correct. Remitting fund to a foreign currency account of another resident individual is permissible if the purpose is gift or donation. So remitting to another resident individual foreign account is prohibited. So this statement is not correct. The scheme permits extending loans in Indian rupees to NRIs who are relative subject to conditions under Companies Act 2013. So this statement is correct. The annual cap of USD 250,000 under LRS applies uniformly to both current and capital accounts without restriction on the number of transactions. So this statement is correct. So there is a restriction on the amount and not the number of transactions. So 1 is correct, 3 is correct, 4 is correct, 6 is correct, and 7 is correct. The 1, 3, 4, 6, 7 making option A as the correct answer. Examine the following statement about Indo-Nepal Remittance Facility Scheme. The Indo-Nepal Remittance Scheme permits account holders in Nepal to send funds to India using IMPS and RTGS. It uses NEFT system, not IMPS and RTGS. So this statement is not correct. Remittances from India are settled in NEFT batches by NCC Mumbai and routed to Nepal via dedicated SBI payment gateway. This statement is correct. A Nepalese migrant worker without a bank account in India or Nepal can still use the scheme if valid identification is provided. This statement is actually correct. The maximum amount of single remittance under the scheme is 1 lakh. No, it is 2 lakh. So this statement is not correct. The beneficiaries in Nepal receive the remitted amount through Nepal State Bank Limited and its approved agents in Nepalese rupee. This statement is actually correct. So 2, 3, and 5 are correct, making option A as the correct answer for this question. I hope you clearly understood this unit. It is quite important from your exam point of view. Let's meet again with unit number 9. Till then, please take care and bye bye.